very, very smart people aren't always right. They were suggesting that quantitative easing should really cause hyperinflation. And I was saying, well, it can only cause hyperinflation if the money is handed out in the economy like we had over the pandemic. But this time it wasn't. It was only kept on bank balance sheets. We're looking at the market and it's not causing that.
The algorithm. What do you make of this?
Well, it's a great marketing tactic, don't get me wrong. My issue is with the truth of how things actually work.
Mean reversion is something that we don't tend to hear on prop firm podcasts very often. It's all very generic, whether it's ICT, SMC, price action. What's that?
If you do something called linear regression, so you take a time series and then you basically find a line of best fit, what you'll notice is that some prices appear at 1, 2, 3 standard deviations. So if you've got a price that say goes to 3 standard deviations is kind of out of the ordinary, right? You expect that to come back to the average at some point. That's what mean reversion is. Okay. So if it goes too high, sell it back down.
Hey guys, and welcome back to another episode of Trader Talk. Today we have Berkheim back, and we have my good friend David Bell as our guest today. So I'm super excited to get into this conversation, as this is going to be a little bit different to what we're used to. Welcome.
Hello.
Welcome, Dave.
Nice to see you.
Yeah.
How are you?
I'm alright. I'm doing well. I think, over a little turbulent patch, but we've got to keep going, don't we?
Okay, I mean, shall we just dive
What's that? Oh yeah, so a big investor was meant to invest in my business. He ended up being a massive fraud. So it's one of those things where you're more concerned about the waste of time rather than the money that went. I couldn't give a shit about the money, quite frankly. It was a waste of time. But anyway, we keep going, we're raising now. And so things are moving up.
Lovely. So what is it that you do?
So I run Think, which is a research platform for retail, higher end retail and professional investors. That's pretty much who we focus on. Purely because the strategies that we look at are probably more suited to that kind of investor, I guess. But from there, what we do is we take complexity and then we distill it down into the simple while retaining those complex topics. We tend to find that a lot of people, when they're trying to explain complex things in the markets, they remove all of that complexity. And so it just doesn't portray the right picture as to what you're trying to explain. So we try and keep everything in there. And from my background in broking, I understand what the funds are looking at, what everyone else is looking at. And obviously my experience with trading for about a decade now, I think. I think I'm well placed to actually convey that message. And so, yeah, I think it's definitely a place for lots of different people to come. But if you are a keen learner and you wouldn't kind of consider yourself a high-end retail trader, I think there's still a lot that you can get from throwing yourself in the deep end. So that's where we come from.
I was going to say, obviously I've been following Think for quite a while now, and some of the things you talk about, I'm just like, what?
Do you know what? I think we get that quite a lot, and I do think it's kind of an initial anticipation type nervousness or fear. It's like, oh, I've never encountered this before, so like I'm going to be scared of it, I don't know about it. And it's like, these things aren't that complex. It's just they're seem complex by people that are gatekeeping kind of the knowledge and the context around it.
So in layman terms, like for everyone to understand, how would you explain it? In like, if you were to explain it to a 10-year-old kid.
What, trading or markets in general? Or?
Just in general, like in markets in general, trading.
So in general, what you're looking at in markets is supplying a price when no one else wants to. That is what you're doing as a trader, effectively, because you're giving the market exactly what it wants, which is creating efficiency, okay? And that is effectively what we are doing as traders and investors. You're providing a price where the market thinks something is either under or overvalued, and then you're trading it back to wherever that fair value is. That's basically what we're looking at.
How did you get into this? So where did your journey start of actually getting into trading? Because I know you have like an extensive background and very good credentials. What made you get into it?
So it's from A levels. I did an economics A level, and obviously when you're economics at A level or university, I went to university and did economics as well. It's so boring.
Wow.
And if you're doing it you're researching stuff on YouTube, you get targeted by adverts. If you're typing in interest rates or stock market or something like this into YouTube, you get hit by FX broker ads. And I think the first one for me was CMC, because I remember asking them why the price wasn't moving on euro dollar on a Saturday. So that was one of my very, very first sort of forays into the market. It must have been when I was 17 or 18. I think it was 17 because I could only use a demo account because I wasn't 18 to open up a live one. And so that was one of my first big sort of mistakes that I had, which was realizing, oh, everyone's been saying it's 24/7, when actually no, it's 24/5. And so, yeah, I think it was CMC, and then I got in touch with the head of FX Street via a course via the University of Essex as well. And then from there, that's kind of how I got my into trading, broking, and the whole world, basically. So it basically came from networking in the right ways and putting myself out there. I wasn't academically gifted at economics. I absolutely hated it. And I thought it was completely useless as well.
Yeah.
Because at the time, when I was at university, it was 2011 to 2014. So that's when QE was going off. And they were talking about like, oh yeah, printing money will cause hyperinflation and all of this. So I was arguing with my professors, I guess, right? These really fucking smart people, and this is a lesson to take as well. Very, very smart people aren't always right. They were suggesting that quantitative easing should really cause hyperinflation. Mm-hmm. And I was saying, well, it can only cause hyperinflation if the money is handed out in the economy, like we had over the pandemic. Mm-hmm. But this time it wasn't. It was only kept on bank balance sheets. So that was my argument. And these guys were saying back to me, no, it's going to cause hyperinflation, it's going to cause this, that, and the other. And I was like, well, no, we're looking at the market and it's not causing that. So I'm taking the actual evidence from how asset prices are moving, apart from housing maybe, and I'm suggesting that the CPI measure is not moving, asset prices are actually moving, but that's not the point. The point is that inflation isn't actually going through the economy. So that was my dip into being very, very cynical about how academia interacts with markets and how I personally think that a lot of this theoretical stuff is complete bullshit.
Yeah, I agree. Because I also studied A-levels, economics A-levels as well, and it's like your professors and your teachers, they only go with whatever's in the book. And it's always the macroeconomics, those textbooks and everything they've learned back in university. It's like they think it's the right way. Yeah,
and the thing is as well with the macro side of things is I used to be very, very heavily macro focused, but from a different perspective to others, because the way that a lot of people look at macro and how you have to look at macro is that monetary policy, for example, is continuous over quite a long period of time. So, if you've got low interest rates, you just buy stocks, right? Mm-hmm. But these macro guys are always looking for that to change. But the default should be that you're buying stocks and that stock market should go up if growth's there, if all of this is there. And so these doomer guys are putting this all this shit out on Twitter and stuff like that, saying, oh yeah, the market's going to shit, housing market's going to shit, all of this. And it's like, well, no, you've been wrong for the last 10 years. Like, just shut up. And so now I'm very different in how I approach the market. It's very much momentum focused rather than focusing on what unemployment's fucking doing, because no one gives a shit, quite frankly. And it will change in 3 months' time, so who cares?
I was gonna say, because that's kind of how we met, was through the fact that you're the macroeconomics guy, and obviously for those who don't know, I met David. I think it was through Twitter, wasn't it? That we initially started speaking, and then obviously you spoke at FX Connect. Mm-hmm. But we wanted you because you were the macro guy to go to. Yeah. So are you not as focused on that side of it anymore?
I am, but only from a risk perspective. Mm-hmm. So it's not necessarily from an opportunity perspective a lot. I'll take special situations and use it from that perspective, but it's not like I'm building a trading strategy anymore around, okay, what is unemployment doing? To be fair, I don't think I ever did that. Mm-hmm. I would focus on certain perspectives where, say, China might be dumping copper. What would that do to the price of the Australian dollar? Probably, lower, because there's less copper being bought from Australia and stuff like that. But I would never be specifically, like how some of these guys are that I see, they're talking about oh yeah, if unemployment goes here, that's the stock market done. It's just total bollocks. That's not a strategy. That's just you trying to get likes on Twitter. It's just nonsense. So I think from that perspective, the macro can be used to formulate a kind of risk strategy, and also spot some opportunities where you might see serious extension or overextension, which can lead to a trend. Today, for example, we've seen non-farm payrolls come in under target, so the US employment situation is a bit shit. But generally, I just like to see if stocks are going up and then just buy them. No, FX, I've got different strategies based on mean reversion and options pricing. It just depends on what I think's going on in the market at the time.
Talk to us about that keyword, because mean reversion is something that we don't tend to hear on prop firm podcasts very often. It's all very generic, whether it's ICT, SMC, price action. What's that?
Well, mean reversion is just if you do something called linear regression. So you take a time series and then you basically find a line of best fit. What you'll notice is that some prices appear at 1, 2, 3 standard deviations, which is basically like an extension past the average, if you want to talk about it that way. You know, the definition of average is that a lot more prices are at that average, right? So if you've got a price that, say, goes to 3 standard deviations, is kind of out of the ordinary, right? You expect that to come back to the average at some point. That's what mean reversion is.
Okay.
So if it goes too high, sell it back down. That's basically what it means, and try and get out of the average. So that is a trading strategy there. It's what a lot of quants do. It's pretty much what all quant finance is based off of. So if you can spot certain trends, perhaps, that's occurring based off of, you know, linear regression or mean reversion, in FX that works especially well because, you know, you're always counter one currency. If you're buying yen and you're short the dollar, basically, then, you know, you can definitely spot certain times at which that should work quite well.
Going back to quants, I've realised that it's not the technical analysis that they're using these days. It's all based on the macros, and of course with the use of like algorithms and everything. So the whole spectrum of trading has changed. Look at the investment banks, like who they're hiring. They're hiring the guy who's got a master's in physics, who's got a PhD in physics, rather than someone who's got an investment banking degree.
Yeah.
And they don't care about that. And it's like, where do you think they base their analysis off? Is it just like the world, politics, and everything that goes around, or? So
I've seen one of Bridgewater's models, and there's probably about 200-300 inputs that I can see. Not the specifics of it, but I've seen, like, you know, a kind of flow chart about how it works, and there's so many different inputs. But generally, the big difference between what the quant buy-side firms are doing, you know, the big research teams, what their big edges is infrastructure, talent, and also the quality of data that they can obtain. So you and I can go and get, you know, the last 10 years of S&P 500 data. But the problem is that how clean can we obtain that data? How quick can we process it? These are things that us as maybe individual quants, I'm not a quant, I couldn't tell you the last thing about how to do a lot of that shit. But us as in sort of individuals, if we're trading at home and doing quantitative strategy creation, that's the big difference. It always comes down to money and the amount of bandwidth you have to do certain things. So if you've got, you know, the fastest computers that are able to process a shitload of data, you know, you're going to have an edge. If you're close even to a stock exchange or a futures exchange, you're going to have an edge because even that 10 millisecond of latency or whatever speed it is, that is going to make a difference. So you've got so many different advantages that most people don't think about, which is why I always say to the retail trader, try to extend your time frame, because what you're doing, if you're scalping, for example, is you're competing against literally the smartest of the smartest of the smartest, richest people in the world. Yeah. So an easy way to obtain an edge is to basically have the ability to ignore all of that short-term competition. Ignore that competition on the really short time frames intraday and extend it out to at least a week, a month. It's obviously a little bit harder to do with funded trader programs because, you know, there's rules and things like that. But if you're investing in unleveraged products, that is where you should really focus.
Right, I see. What was that book called? Oh my God, I read a book on, I've completely forgotten about it. It was based around when they first came across sort of just taking high algorithms and how if you're closer to the exchange, it was based in New York.
Flash Boys.
Flash Boys, that's the one. Yes. I read Flash Boys a while back, and that was the whole concept of the book. How being closer to the stock market, having that just ticking in and out, and making millions of that. Yeah, it's a really interesting book.
But there's even stuff in there though that goes down to how regulators operate. So like at the exchanges, what they'll do is they'll basically almost rebate the likes of Citadel, the likes of SQR, the likes of Point72, who are all making markets at really, really high speeds. They'll effectively rebate them for doing so much volume on the exchange. And you'll notice that in the US, CFDs are banned. Why is that? Because they want people to do futures volume as a derivative product. They don't want to do OTC derivatives in the same way because everyone else benefits. The exchanges benefit and the HFT providers benefit. And so it goes down to the very, very core of markets and how monopolized they are in the US, that these HFTs are actually operating. And I don't think that's necessarily a bad thing. I think everyone actually wants to operate with them there. Sometimes they can get a bit sticky because they can remove liquidity because there's no human element, and then, you know, the market absolutely shits through for no reason. But generally, they're keeping things ticking over. They're keeping, you know, costs lower for the average trader.
And what do you think the current percentage of liquidity comes from retail in comparison to the banks?
Not a huge amount, you know. I'd say maybe in FX, you're probably looking at maybe 10, 15%. The rest is out of that speculative volume, of course, like 70% in FX is speculative volume. The other 30% is payments and things like that, which is crazy to think about. But at the end of the day, that speculative volume is what provides the liquidity for payments to be made quite nicely, you know, and nice and cheaply. So I would say retail is such a small component in the FX market. A lot of the FX market turnover, though, is recycled liquidity. So you'll see from different liquidity providers, they provide prices and stuff like that, but it gets turned over between them. And so I don't think the FX volume daily is like 5 trillion or whatever the reported number is. I think it's like 1 trillion or 2 lower,
right?
Purely based off of that.
I want to talk about our favourite subject, the algorithm.
The non-existent algorithm.
What do you make of this phenomenon?
Well, it's a great marketing tactic, don't get me wrong, because he's found a group of people that are willing to get sucked in by this view. And this isn't necessarily about the strategy. I couldn't give a fuck about whether ICT or SMC or whether the strategy works. Like, do what you want. My issue is with the truth of how things actually work. And in FX, there cannot be an algorithm because the way the FX market is composed of is that you've got dealers, right, at the banks. You've got people like XTX who are non-bank liquidity providers who are also quoting prices. And so if I'm Deutsche Bank, I'll quote on euro dollar, like, you know, let's say just $1 on the bid, and then on the offer, and then on the bid I'd quote $1.00001 or something like that, you know, and someone will accept that price or they'll not accept it because someone else has provided a tighter spread. That's how it works. There's no fucking algorithm coming from the Bank of England. Because what if there were an algorithm coming from one central bank, there would have to be competition with that algorithm with another central bank. So the Fed would have to have their own algorithm. The Bank of England would have to have one. The Bank of Canada would have to have one. The fucking Bank of Timbuktu would have to have one. And it makes no sense for this to happen. I'm sorry, but anyone who thinks that it exists is just thick, and their knowledge of the market's infrastructure and composition just isn't there, quite frankly. I was getting at ICT about this in 2015, and he's kept it going.
Because you have like a bit of history, don't you, ICT?
Oh my God, like he's blocked me on every single account because I'm just like, and I don't care. Like if his methods work, whatever. I don't know if they do. I don't see how a method that, you know, what seemingly is 80% of retail traders use now. I don't really see how it works. There's got to be something else about the method or about the specific person that lets that strategy work if they're profitable. I think it's either risk or, you know, when they trade or something that is very bespoke to them. But I just like the truth, and I don't like the fact that he keeps saying this. You know, he keeps saying this nonsense, and he's done it for a decade. So.
That's your thoughts on them?
Yeah.
It's crazy because I think I first heard about ICT probably maybe just before COVID or during COVID, because I came into the industry, I was purely price action. Like, hearing about ICT, I was like, who's this guy? Like, inner circle trader, like, I had no idea. I think the only thing I actually picked up was, like, a fib level. But when I went onto Twitter in, like, 2022, I was, like, bombarded by this cult of ICT traders who were like, ICT is the way and this is the only way to trade. And I was like, what the is this? Like, I was so confused, and then I went on a whole thing of like, he's the alphabet man, because you're called ICT, you use FVGs, OBs, and why do you use so many letters to try and explain everything? Like, I don't.
Because it's just, it's a way of just, I guess, creating some kind of secret. You know, it's a club.
Yeah.
You know, if you've read anything about fans or, you know, tribes, which I have, a really good book by Seth Godin, actually, everyone should read. You've read it?
I haven't read it, I've got it.
Literally, all he's looking for is a viable audience that's going to believe this stuff, you know. And
Found it.
the sell, yeah, exactly. The sell is the allure of, oh, these people don't know this secret. That's what it is. The actual stuff is, you know, stuff that's out there. It's just renamed, and you've got funny boxes and stuff like that, you know. If it works, fine. I don't give a shit. As I said, all I care about is the truth and how the market functions, and he's just lying if he says that it functions in that way. And he knows it. He fucking knows it. He's not an idiot, you know. He knows that he's talking shit, but it is what it is.
These, like, because there's a lot of groups, right? Everyone trades this strategy and that strategy, and it's all like different types of technicals and this and that. But it's like drawing a few lines on a chart. Do you think that really determines the pattern or what's going to happen in the market?
No, I think as I've said before, in FX is predominantly mean reverting. If you're looking at a resistance level, for example, you're probably going to sell that resistance level because it's mean reverting back into a specific range, right? I think breaking away from that specific understanding of, okay, we're selling a market because it's just at resistance, and we're buying a market just because it's at support. You have to then understand, okay, what might cause this market to start trending? Is there a specific thing? Am I looking for something that is an event that is going to increase volatility? Which you can price. You can look at implied volatility, and you can look at certain other metrics, which is what I go through. I look at options price and straddles, stuff like that, to see, all right, well, is the market mispricing this currently? It's happened a lot with FOMC, is that everyone has bought volatility on FOMC, but actually post-event, it's led to volatility being sold off heavily. Right. So basically people get scared and then they buy volatility into the event, but then the actual disaster doesn't happen. And so they sell it off and then the market rallies. Yeah. And then that crosses into FX. So there's lots of different ways that people should be looking at the market that they don't. And I think this is why there's a lot of frustration that's generated. I'm never frustrated. I don't get upset at the market because it just is. And also I'm never selling anything. I'm just buying stuff and then closing out a little bit each time. So, you know.
So what about the whole concept of backtesting? Because you'll have people who sit there on a demo account for like 3 months before they even live trade a single penny.
Yeah, well, the first thing that I ask people about backtest is, what are your costs? You know, have you included your costs? No, your actual trading costs. Okay. You know, spreads, slippage, you know, your commission that you pay if you're doing STD or something like that. Okay. You know, because I think there's a lot of retail traders that are profitable, but their costs are what make them break even or eat them up. And brokers know this. Brokers absolutely know this. And so that is one of the first things to identify when people are talking about backtest. Mm-hmm. If you're trading exotics, for example, what if your spread is like 5 ticks, but then your average win is only 6? Like, what's going on? Especially if you're scalping and stuff like that. So there's lots of different things to consider. Backtesting can work, but it has to be done properly, and you have to run a Monte Carlo simulation to actually understand your strategy. You can't just look back at your last, 10,000 bars and off your own mind go and look at it and say, oh yeah, this strategy's kind of working. Like, it doesn't work like that. Right. Unless you're trading it kind of longer term. But intraday stuff, you really, really have to focus on costs and actually running the simulation properly.
Technicals versus fundamentals. So a guy once said that the market is purely based on technicals.
Yeah.
And fundamentals don't mean anything. What do you think about that?
Well, I'd ask him why does a market exist in the first place? Is it because there's some special lines that are on the market, or is it because people demand and supply stuff? What is that demand and supply based off of? Well, it's based off of stuff that's going on around us, right? So it can't be based off of technicals only. Technicals are definitely a help, and they can identify certain things. Like, as I said before about the linear regression, I think moving averages are some of the best things to use. I know people might hate them, but they identify when a market is trending, how much buying pressure is in a market as well, depending on how far away from the moving average it is. And if you're using different durations of moving average, you can see, all right, well, some people are looking at it from this duration, a shorter duration. If everyone's looking at it over a shorter duration, and it's also above the longer duration moving averages, everyone's looking to buy it. So just fucking buy it, quite frankly. Like, don't overcomplicate stuff. That's the way that I look at it. If you look at some of the strategies we used to run for clients on execution and things like that, and also some of the, specific just trading strategies generally, a lot of them are based on just 2 moving averages and a VWAP for execution. Getting the market cheaply if it's trending, and these guys are happy to take that, because what they're not doing is they're not going, full pelt leveraged into stuff. They're willing to take a good idea, a good bet on maybe where the economy or maybe where a specific sector's going, and they're willing to say, all right, there's a trend there starting, let's have a go. It's honestly not as complex as lots of people like to make it up. Like the quant stuff, yeah, there's loads of shit that goes into that. But if you're looking at stuff from stocks and looking at like trend and momentum, it's not complex at all.
Right.
Do you know why I asked that question?
Why?
And group chat.
Huh?
And group chat.
Which group chat?
FX Connect.
What happened?
When you left.
Oh, there's powerful stuff in the background.
Oh, yeah. Yeah. Oh, yeah. I remember. Yes.
Did you get pissed at them and you just thought, fuck these guys, I'm out?
It's just some fucking weirdos out there.
No, you called him a and then I got called a
Oh, yeah, but he was a cunt.
No, he is.
Yeah.
He is.
Oh, yeah.
Yeah.
And he's always fighting someone, isn't it?
Not just me, Tamed as well.
But he's a cunt though. Like, what do you want me to say?
I feel like we're very outspoken on Twitter and places like that, and I feel like some people just don't like us for that.
Well, yeah, but that's their personal problem, isn't it? At the end of the day, I'm never horrible to anyone that doesn't deserve it. And I don't think I'm horrible to people either. I think I like to...
You know how to use your words.
Yeah, exactly. I know how to be cutting, for sure.
Yeah.
But, I'm never horrible to people that don't deserve it. I know what I think's right, and I don't like it when I see things that are wrong.
You give me the vibe that you would just stick it on someone you can just pick out as a bullshit.
Yeah, definitely. I tend to do that. But the thing is that there's so many that if you were to go and do that all the time, you'd just be stuck in a circle of... It's
exhausting.
It's so exhausting. Do you know what? Let people get on with stuff these days. Like I used to be able to do that, but now I think ICT is probably the biggest one. But I also respect his hustle in a way. The thing is that okay, we can go the marketing route where we're like, all right, we're gonna teach you all of the right things and all this, that, and the other. But people actually don't want to hear that. So the way that we're looking at things is, all right, let's go over the top. Let's say that you're going to make 100x, but then the content on the back end is actually good. Does that make sense? Because people want to hear that message initially. And rather than them go to some of these crazy spivvy people trading from the pool, then just come to us and we'll actually teach you the right stuff. Do you know what I mean? And I think, obviously being at TradingView as well for such a long time, I came across a lot of people who wanted to get onto the platform that were trying to do that, whether they were trying to push their ideas in there or whatever. And you tend to spot and see a trend of who is sort of like that. And at the end of the day, there's so many that I just had to say, all right, I'm not going to keep calling people that. It's just pointless,
Yeah.
So I think that's the best way to keep peace.
Yeah, I agree. Talk to us about what it was like working at TradingView, because I know when you were there, it was like the #1 most searched platform in the world.
Mad. So I was head of growth there. And then towards the end, I ran their market data and compliance as well. So I was doing a lot at the end. 2020 to 2021, obviously, when stocks were going mad, that was insane. But the thing is that from inside, like they're a Russian company, so they're very sort of regimented. They know exactly what they want. No one was excited. It was just, you know.
I didn't know they were Russian.
They're an American company, but owned by Russians. Really, really good guys. I love, you know, Dennis, Rowan, Stan, all the guys there. There was all this success, like I think it was 59th biggest website in the world, let alone like just in finance, website. Wow. Like there was 1 billion hits in March 2021. Wow. If you search Tesla, TradingView came up first, like in terms of Tesla stock, like it was mad. Totally, like it was just business as usual. We just got to keep going as a business. But yeah, you know, that was a crazy time because everyone wanted to speak with us. Like I was there having 5-6 calls a day for an hour, just one after the other. It was mad, genuinely mad. So it was good to see a part of a company like that, which just within a year just went absolutely bananas, you know. Obviously the FTX stuff was tricky.
Yeah, talk about that.
Yeah, so they were on TradingView and it was kind of like they could and they couldn't be on there according to my compliance policy, but they were just so big at the time that they kind of had to at the end of the day, yeah. And this, I think it all blew up just after I left, but I think that was quite a tricky time. The kind of PR of them being on TradingView, which was the biggest site in the world, couldn't have been a disaster at the end of the day. They just got rid of it nice and quickly. But again, like, I think I'd even spoken with Sam Bankman-Fried at one point.
Is he as weird in like to speak to as he like comes to work?
He's just a weird little nerd, isn't he?
Yeah, that's the kind of vibe that
I think he did descend into a real drug addiction though by the end of it, to be honest. Yeah, it was like the Adderall and respectively meth, isn't it?
Yeah, that was like a rich person drug as well.
What, meth?
Yeah.
Like the difference between opium and heroin, do you know what I mean? Opium, oh, you don't know.
Not a clue.
Okay, he was another. Who else was another? Lots of nubbing in this industry, actually.
Yeah.
Plenty.
Yeah.
Plenty of nutters. Especially the Cypriots. We could get into them. Cypriot brokers. It's all Russian mafia-led.
Because it's most like overseas Cyprus, that's like where
Storage. If you go to Cyprus now, it's all Russians. It has been for a very long time. Limassol is literally run by Russians. And a lot of the brokers out in Cyprus as well. Like, it's all washing money for Russians.
Wow.
Great.
I didn't realise that Russians kind of ruled this industry.
Oh my goodness, it's crazy, isn't it? It really is crazy. I don't know why, and I don't know where it's really come from, but you know, they really, really do. I think they've got a really strong software development sector. That's where it comes from. And also the other states around Russia, like you've got, I can't even give you an example now, Belarus, Estonia, all of those places are very, very strong in this as well, like Admiral Markets. I think is Estonia's biggest company or something like that.
Yeah, they've got the best tech teams in the world, especially their quants even. They've got some quants out there as well. I
mean, the owner of XTX Markets, who is the UK's biggest taxpayer, he's Russian. Yeah. Gurko, like they're ridiculous. Like they're not a bank, but they do like I think third most volume in FX, like in terms of liquidity providing. It's insane. Wow. Like I think he pays like 600 million a year in tax, like income tax. Like it's fucking mad. He makes so much money. I love him.
I was gonna say, surely he knows the loopholes to get around that shit as well. So
oh yeah, like he's
paying
paying like so much less than he should be, and he's still paying that. But yeah, another Russian who's they're very successful. It's just a shame we've gone and invaded Ukraine, but I guess we're not going to get into that. Yeah. Don't want to get demonetized.
Yeah. It's the Q one.
Yeah.
Because they recruit from like their specific universities. Like you heard, the Yandex School of. They've got the Yandex School of Tech. Yeah. They've got Moscow Institution, that technology uni. They have, and there's an insane amount.
Yeah, they got a lot of talent. They got so much talent, and this is the thing with the UK as well. Like, we've got a lot of talent. It's just we've got a government that just doesn't really want to make use of it. Like they just cancelled a £1.2 billion AI project in Edinburgh. Where they're building a supercomputer, and they're like, oh, we don't have the money for it. So who's going to come and do that now? The Americans are probably going to come in, build it, and then keep it for themselves. The Chinese or someone. It's just insane. And so all of this talent that we have just goes elsewhere. It's just mad. Like obviously London's massive for finance, but even then, like finance is just, it doesn't actually make anything. I had an 8-minute rant today on TikTok about that. I had an 8-minute rant yesterday on TikTok about it. Rachel Reeves, I think, is my number one enemy. Like, I just hate her. I just hate everything about this place at the moment.
The Western world is known to be getting dumber for using TikTok, whereas like China, who are the owners of TikTok, they feed their people like educational material, things that are actually going to better them. I don't know if you've seen it online. There was research done on it as well. It's like the average user of TikTok in the Western world is just only getting dumber and dumber.
Yeah, but then when you actually look at China's economy now, you've got a declining working age population. You've got, so I'll give you a story actually. There's a jewelry company whose sales dropped by 25% just in the last quarter. Now you've got to ask yourself, all right, why is it dropping in Macau? Why is it dropping in Hong Kong? Why is it dropping in China? All by like 25% roughly. So this jewelry company was actually being used to get capital out of China. So they'd buy like, 100 grand's worth of jewelry. And then they'd be able to wear it, or they'd be able to put it in their suitcase and then move. And then they've got, the ability to sell their jewelry again, right? You've got to ask then, okay, well, does it mean that there's now not enough money in China to even make sense of that business to basically exist in terms of buying the jewelry and moving the capital out? So what I'm trying to get at is, are there any rich people left in China? I'm not so sure. If you look at Burberry's share price at the moment, China is half of Burberry's sales. Burberry's share price is down at the lowest amount in maybe a decade. And so again, there's more signals to say China's pretty fucked right now that a lot of people aren't looking at. And the fact is, you can't trust Chinese economic data because they'll make it up. They will make it up, And so if you're actually looking at share price data that's listed elsewhere, you've got a much better reflection of the economy.
Yeah, you never really look at it like that. It's more of like, what does the media tell you? And
that's why,
Bullshit, that's why.
yeah,
Do you know why it is though? It's because the media is filled with journalists who, great, they're reporting and stuff like that, but they don't understand point A to B. Bloomberg journalists and Reuters journalists are different, but most people aren't getting their news from that. The average journalist is not in markets, they're a journalist. It's not their role to understand probabilities and risk. And so when they're reporting on the surface level. They don't necessarily understand the bits underneath. It's the same as economists, right? I always question why we trust the expected data whenever it comes out on unemployment and X, Y, Z, because we're like, well, economists are cool, really. What are they actually, what risk do they have on the table? If they get a prediction wrong, they don't lose their jobs or lose any money. So why are we trusting this expected data? So there's a lot of stuff to basically be cynical about in markets, I think, especially from the media.
Talk to us about what it's like working at a broker. What secrets can you tell of working in a brokerage?
Most people, even if they've got loads of money, do shit wrong all the time. It's just they've got loads of money to weather it. At the end of the day, that is what it comes down to, is initial starting capital, I think. Is that if you've got a lot of initial starting capital, number one, you've clearly been able to make money. So you're probably going to be able to make money elsewhere because your baseline level of risk is higher than the average population. And then two, if you also have a lot of money, losing 10% of $500,000 is not the same as losing, 10% of $5,000. Because a lot of people might have had to, go through a lot to make that $5,000. Whether if you've got $500,000, you've probably got a lot more, especially if you're punting it around in the stock market or FX or whatever. So that is pretty much the biggest difference, is 100% in capitalization, And also the other thing as well that I think is really important is that most wealthy people have gotten wealthy, or traders have gotten wealthy, not through consistency, but through very concentrated bets at one point in their lives. They might have gone all in on a specific stock that has then gone and made them 1,000%, say, or they might only have like 2 trades a year that are absolutely fucking mental. It's not day in, day out trading. It's the kind of buffer that they get from a really, really good period, which then lets them do everything else.
Yeah, like the millionaires of GameStop.
There you go, exactly.
Yeah.
But do you know what it is about that? It's the same with crypto. It's knowing then when to exit and just not get back in and lose it all.
Yeah.
That's the key thing.
Yeah.
Or like at least taking out like 80% and then just trading or investing the other 20%. You know, when people come from a baseline where they've not made that money before and they're suddenly a millionaire, they're like, "Fuck, what do I do?"
Mm-hmm.
And it's like people with the lottery, right? They win the lottery and then they go broke.
Yeah, that's crazy to me.
Yeah, I don't know how people do that, but
What percentage would you say of people actually make money in trading? Like from a broker perspective of being able to actually see trade?
it's difficult to say. Do you know why? Because if you look at it over a year, lots of people just drop out. But it tends to be that if people are able to stick it out over a longer period of time, then the odds of them winning go up. They're actually able to stick it out. And number two, because they've stuck it out, they found something that works. And it might mean that they completely change what they're doing. But I think, it comes down to that specific thing to do with that individual a lot of the time. I don't think there's a joined up reason as to why people are successful or not. I do think the capital is one of the biggest things, which is where funded accounts come in as well. You know, for people who are just starting out, it is a fantastic opportunity. Okay, only a small amount might make it, but at least you know what your fixed risk is. And I actually say that a lot of people should use funded accounts for testing their strategies out rather than actually trying to make it.
Yeah.
Because what you've got is, rather than testing on demo, you've got a live scenario where you do actually have risk on the table. So you are feeling, the emotions. You know, you do want to win, but at the end of the day, it's not the end of the world.
Yeah.
Right. And you can still use the lot sizes that you'd use in real life. And also from a business perspective, it makes sense for you guys too. So, I feel like that is probably one of the really, really strong reasons to use a funded account these days as well.
Yeah.
I think it's important what you said about the fact of like sticking it out. Like the successful traders are the ones who just stuck it out and just continued. I feel like with this industry in particular, a lot of people come into it because they see the lifestyle, they think everyone's gets rich, and then they come into it and they're like, oh shit, like this is actually a lot harder than what they expect. So I think it's just good for people at home to understand that if you are just gonna, if you come into this industry, the most important thing is to stick it out, and you're not going to be successful if you don't stick it out, obviously. But just going through that time and sticking it out, in some ways you are kind of guaranteed to see some kind of success.
Yeah.
With it.
But I think as well, like everyone says, don't like rely on one trade. I think that, listen, most of the success comes from that one home run that you get a year. Like you'll be in a trade and just be like, yeah, I need to go fucking all in here pretty much. But people advise against that. When in reality, those concentrated bets are the ways that you actually do it. Because what's going to happen is that if you're looking for like 1-2% a day or whatever the fucking barometer is these days, the chances that you're just going to end up decaying and you're going to get frustrated and you're going to fuck up. Whereas if you're able to like make, 250 to 500% at one point in the year on your account, you've got that buffer and you feel safer. But then it's about managing, okay, all right, I've made that, let's not give it back. Well, that's obviously the big thing. But people don't press hard enough when they're right. That's one of the biggest issues, is that they don't go balls deep enough, quite frankly. And they need to. That is one of the big things. But it's the same everywhere. Like, again, if you take the example of the government, they're not pressing hard enough in their risk taking. It's always this aversion. You can't be too passive, that's all. So I think people need to really, really get a bit wiser to that.
I recently heard that on a podcast, actually. Like, I can't remember who it was that was being interviewed, but they literally said, like, find that one trade that you are, like, absolutely confident on and just completely back yourself on it. And that is, like, the difference between, like, an average person and the Warren Buffetts of the world.
Like, I'll give you an example. So we run a model portfolio, which is always going to remain 55-60% S&P 500. The rest will be other momentum stocks that we're looking at. And the reason is because we believe so hard that the S&P 500 is just going to continue going up. But there is no point in trying to decay by being in anything else. We think that if we can just keep adding to the S&P 500 over the next year or two, it will still be in a better place. And so that, I guess, is a concentrated bet. If you look at the composition of the portfolio, 55, 60% in something that you truly believe in. It's like, I respect Bitcoiners because they are so fucking ideologically driven that they're just like, yeah, I'm gonna mortgage my house and put it into Bitcoin. And you shouldn't do that, obviously, but like, I respect exactly what they're doing because they believe that this market is going to go up so much and they're willing to weather the volatility. It's great. I like it. Sure.
What do you think about crypto?
My opinion on crypto changes depending on whether I've just been fucking rug pulled or not. So in Solana, which is like the real like pump and dump stuff, sometimes you can have a really good run, and then sometimes it's just like, stuck this. This is just complete bullshit because someone will tell you, oh yeah, this is going to go to like 1 million market cap, and then hits 100, and then you're 100 grand, and then like it just goes to zero. You're just like, fuck you. Like, I hate all of you, but at the end of the day, you know what risk you're getting into. You can throw in 100 quid and come out with 10 grand.
Yeah.
Like, it happens, and you can lose, whatever. The returns are insane if you can crack one. It's a ridiculous market. And I think if you're only chucking a few hundred quid in a month and you catch the right one, you can come out with a good few grand.
But there are good opportunities to get involved in. As you said, a few hundred quid, especially if you get involved in like the ICOs and the IDOs that they have as well. Like, you can get into some good projects. Not, of course, when the market declines, then liquidity gets swiped and gets swept out and the whole project goes down. Well, BSC, Binance Smart Chain, started off with like the whole ICO concept. I'm not sure if you got involved in that, and there's Solana's now involved in that as well, where they've got a lot of like VCs getting involved and everything. So I think crypto is doing much better, but I feel like maybe there needs to be an element of regulation.
That's the thing, is that you're looking at it from a premium perspective because there is none of that oversight. So people are willing to take these risks because they might get rug pulled. That's what really, really drives it high. So there's like a double-edged sword. Yeah, there should be some regulation. I think it's going to come in. But also, if you do want that price appreciation, you can't regulate it.
Yeah. Have you seen Smurf on Solana? It's
recently just come out, isn't it? Yeah.
It went crazy.
Yeah, some of them go like 10 billion. It's literally insane.
Yeah, it went
I can't
crazy. And like these tokens come in and like people get driven by, I don't know, someone, it could be like an influencer who got involved or something like that, and then all of a sudden it goes rocket. But then a lot of influencers also get a lot of backlash with rugs as well. Like you saw KSI, he got hit hard.
But the thing is that people complain when they lose, but they don't complain when they're winning. Do you know what I mean? It's like, well, they don't give any props when it wins. Do you know what I mean? So it's like, come on. Be fair, you know what market you're getting into, just have some balls.
And on that note, guys, we are going to leave it there until next week. So make sure you tune in again where we will be continuing this conversation.